I guess at this point you've had such rallies, certainly in U.S. equities. You're kind of looking for what the next surprise is going to be, and you're concerned clearly at this point that it's more likely to be a negative surprise as opposed to a positive one. All the information clearly that we're getting around new cases and deaths, not only in the U.S., but we need to also pay attention to what's happening in Australia. Melbourne having to be put under lockdown, after, generally speaking, Australia considered a country that had handled the pandemic successfully, but nonetheless not able to move as quickly as they would like out of lockdowns as well. So I think we perceive all the risks that surround us at the same time that we know developed market equities have done very well. And then you look at what's happening in China. And as you point out, the parallels to 2015 and 16 certainly seem to be there. The only thing that perhaps is a little bit better is back in 2015-16, what you saw is a fairly significant disconnect between the domestic Chinese A-share market and, say, for example, the MSCI market went up very, very quickly. As we know, the other markets not so much. At least so far, you're seeing all three markets kind of move in parallel. So I think if there's going to be a warning sign we need to be looking for, it's whether or not there opens up again a gap between the indices, which might suggest that things are being driven by less than fundamental factors, if you will.
Daniel, we're on the cusp of earnings season now. For the second quarter, estimates for the S&P 500 declined roughly a 43-odd%, which is just staggering, isn't it? 43% drop anticipated. What's going to change, do you think, as we get a deluge of information? Do you think investors are going to peel away from areas that have been bid up so far and widen out their exposures, or are they just going to double down on the areas like we have seen in technology and healthcare?
Well, without question, the bets on technology are one of the things that concerns us the most. Weeks ago, we were already concerned about valuations. And so if you were concerned about valuations a few weeks ago, you're even more concerned now. So we do think the outperformance, at least a relative outperformance that you've had within technology, certainly in the US versus the rest of the market, might be at risk. There kind of only seems so far that they really should go. We've already, I think, anticipated and priced in a lot of the longer-term growth, positive longer-term growth implications for the sectors. I think as for the earnings season, as you point out, the numbers are going to be terrible. In a sense, that won't matter so much at this point because clearly we know it's going to be bad. So I think investors are going to cling to whatever information they can get, and that may be limited. We know that a lot of companies have dropped guidance. Whether they're going to feel any more comfortable now about offering guidance isn't clear. But certainly whatever guidance we get, the markets will trade on that, either positively or negatively. And I think the other thing that will matter in the earnings is, as always, do we get earnings surprises? And I think it is worth remembering that in the first quarter, even though, again, analysts had marked down their estimates dramatically, the numbers were very, there were still positive surprises. And what we need to take away from that is that analysts had done, if anything, too good a job in marking down their earnings estimates. So in the end, companies did better than expected, even though the numbers were bad. So if we repeat that pattern this quarter, earnings still down a lot, but not quite as bad as we had expected, that's something that frankly could support equities for a while longer.